In this presentation, we will take a look at the audit process related to income statement accounts. So as we've gone through the auditing process, you'll note that we focused in on the balance sheet accounts. That's typically going to be the case. As we do so, we will be looking at the cycles, the different types of cycles, such as the purchasing cycle, the revenue cycle, or the accounts receivable cycle, and the accounts payable. When we look at those items, we'll actually be touching on a lot of the income statement type of accounts. When we consider the income statement, you might be thinking, oh no, we're just getting started here because we went through the balance sheet, and typically the income statement is longer than the balance sheet because it's got a whole lot of accounts, most of them being expense accounts. But note that many of those types of accounts, we've actually done audit testing for them as we've gone and tested through the processes, the controls for those processes, and the balance sheet accounts, because as we test the balance sheet accounts, we test the related processes and accounts to them. Therefore, when we start to look at the income statement, it won't be as complex as we would think, because a lot of the buckets that we have to fill up in terms of audit evidence to get enough audit evidence has already been done as we've been completing the process going through the balance sheet type of account. So keep that in mind as you go through the income statement. It could look really tedious, especially when you're learning this stuff and you're starting to say, okay, we're starting at cash and we're going straight down the balance sheet and then we're going to go to the income. It's going to take forever. But just note that obviously as we compile that data up, we've also been filling up the buckets as much as we can for every other type of account and process, going through and being as efficient as possible. So as we get to the later accounts, such as the income statement accounts, then we already have a substantial amount of evidence related to them, hopefully, at this point in time. So the audit of the income statement accounts, often the largest account on the income statement is the most important driver of the business operating results, is the revenue account. So clearly revenue is going to be a driving factor. The sales account, the revenue account, whatever the income or primary income account is going to be one of the most important accounts, or the most important account on the income statement. One, because it's going to be a large number. And two, also it's going to be the thing that basically all the other pieces of the income statement and even the balance sheet, you can think of the purpose of them being there. I mean, you can think of, from an accounting standpoint at least, the purpose of the business is to generate revenue. The generation of revenue is the purpose of the business, and therefore the actual revenue account then is going to be one of the primary accounts. That's what the existence of all the expense accounts are there to help and to generate. So three primary reasons revenue is going to be important and something that we need to spend time on is, one, is complex accounting standards. So notice it can be complex to know when we're going to be recognizing revenue. Obviously, we'll be using an accrual statement or accrual basis most of the time when we're talking about the auditing process, meaning we're going to be using a revenue recognition principle. But that revenue recognition principle, when we recognize revenue, can be more or less complex depending on the type of industry that we are talking about. So we want to make sure that we understand when revenue should be recognized. High fraud risk, because of course, if a company's trying to look good, one of the major accounts, it's going to be a high, dollar amount type of account that can be involved in that process, would be to adjust revenue in some way, some fashion. That could take different forms, and it could take forms such as the cutoff testing is one way that it could be used. And we've tested for this to some degree when we've considered things like accounts receivable, testing for accounts receivable and cash. But you can imagine that if you're trying to look good, what's the first thing that would pop into someone's mind if they were gonna try to deceive on the financial statements and look good? Well, what if we posted a fictitious sale, right? Sales would be increasing, accounts receivable would be increasing, everything, assets would go up, and the sales would go up. So there's going to be a high risk of basically a fraud in that area as well. Need for estimation. So if there's any kind of estimation involved, anytime we have to estimate something, estimating things that are, related to the revenue, such as how much of that revenue is not going to be collectible, how much of it will be basically bad debt expense. If we have warranty type of issues, what kind of issues might be included with those type of sales, because of course those are going to be related to the sales items as well. Discount issues, any kind of thing that we have an estimate involved, is going to be raising the concerns, because obviously then An estimate is not exact, and it's going to be subject to some fluctuation depending on how the estimate is done. So we want to make sure to test for that. So audit income statement accounts. The income statement audit will depend on the amount of work performed on the business internal controls and balance sheet accounts. So remember, we're down here on the income statement. We've already gone through all the balance sheet accounts, thought about the controls for all the balance sheet accounts and the processes, and the amount of testing we do then on the income statement will depend in part on the work that we have done thus far and the amount of the buckets you can think of evidence we have already filled up with relation to the income statement accounts, which we are now thinking about. Substantive procedures on income statement accounts could include things such as the results of testing of controls for various business processes. So when we consider the testing of controls, that is something that we're going to apply to the income statement accounts, because when we think about those business processes, something we've typically already done in terms of like the sales process and the purchasing process, then those are going to be included because income statement accounts and balance sheet accounts will be included in those tests of controls. The results of tests of balance sheet accounts and related income statement accounts. So when we consider the amount of evidence, we're considering the balance sheet accounts that we've tested, things like the accounts receivable and accounts payable, purchasing, and the sales cycle. As we think about those cycles, we have also tested for income statement or related income statement accounts as well. We want to keep that in mind. Substantive analytical procedures of income statement accounts. So we'll talk about substantive analytical procedures. Recall that those are going to be the type of procedures that I would imagine the auditor kind of sitting in the auditing office. It doesn't have to be at the client's office. We're not pulling invoices. We're just basically comparing numbers, doing ratio type of analysis. Very important for the income statement, because obviously if we take the income statement from this year, performance statement, revenue and expenses, and we compare it to the income statement for the last year, performance statement, we take the difference between the two in both dollar amount and percentage change. We can then analyze basically large changes from year over year and do things like this type of analytical testing, and then think further in or dig down on those changes that seem significant. We can do other further kind of ratio analysis. The income statement is a place where, of course, the ratio analysis will be very useful. Test of selected income statement accounts. Then we'll have selected income statement accounts that we may do further testing on. Now we will consider control risk related to the business process. Revenue process audit findings are important because good controls provide evidence on sales, accounts receivable, allowance for uncollectible accounts, and sales returns and allowance account. Now note, as we consider those controls, we're looking at the income statement account here, sales, the revenue type of account, balance sheet accounts, as we've considered this process as well, these controls related accounts involved in the process, accounts receivable, allowance for uncollectible accounts, and then we're concerned also with the sales returns and allowance accounts here, that being an income statement account, going to be a contra kind of sales account. So basically a contra sales account looks kind of like an expense, but really it's kind of a contra sales account. Audit findings related to the purchasing process are important because good controls provide evidence on most of the expense accounts. So then, of course, when we think about the purchasing process, the controls related to them, we think about what's going to be involved in the purchasing process. We've considered accounts payable, but we've also been testing many of the expense accounts with regards to the purchasing process as well. So as we consider the purchasing process, we have been doing testing on income statement accounts, those including many expense accounts. Direct test of balance sheet accounts. Now we're thinking of those direct tests on the balance sheet account. Income statement accounts are generally audited while auditing the related balance sheet accounts. So when we think about the balance sheet accounts, we're often auditing the income statement accounts that are related to them as well in that process. For example, accounts receivable and allowance for uncollectible accounts. The balance sheet accounts will also be auditing, in essence, the bad debt expense as we go through the process of auditing accounts receivable and allowance for doubtful accounts. Notes receivable, investments, accrued interest receivable, the balance sheet accounts that we've gone through and audited as we go through the balance sheet. We'll also be auditing the interest income as we think about those notes receivable and investments. The property, plant, and equipment and accumulated depreciation accounts, the balance sheet accounts that we have audited. We'll also be auditing the income statement accounts as we went through those balance sheet accounts, including depreciation expense, gain or loss on sale or retirement of assets. These are things that are just naturally going to have to be audited in essence at the same time because they will be related to the balance sheet account. Then we have prepaid insurance. When we went through the prepaid accounts and prepaid insurance for the balance sheet accounts, we also, in essence, were gathering audit evidence on the income statement account of insurance expense. And then we have the long-term debt and accrued interest payable. As we were auditing long-term debt and accrued interest payable, we were also auditing, that being a balance sheet account, by the way, we were also auditing the income statement account of interest expense. So you'll note that, again, a lot of testing has been done as we've gone through the balance sheet for the income statement accounts already. Substantive analytical procedures. So these are on the income statement accounts. Analytical procedures, again, these are those procedures that we do. Basically, we're in our audit office and we got all our numbers and we're comparing and contrasting these numbers from the coziness of the audit office, not having to go out to the clients. And so that's what we're doing here on this analytical procedures. So we have the common size income statement for current year and the previous year. Note that this is going to be a one way that we can make the comparison and a little bit easier to see. So we can compare the numbers, the dollar amount totals, and see the differences between those. We can have a common size income statement, which is basically breaking down the income statement and comparing each line item to the core number on the income statement, sales, and having kind of a ratio statement. And this makes it a little bit easier or a different way to compare and contrast the income statement numbers from an analytical procedure perspective. We can also take a look at the percentage change in income statement accounts for current year and the previous year. So that would be more of our standard kind of lineup. We'd have the current year, the previous year. We'll take the difference in terms of dollar amounts, but oftentimes we want to see that difference in terms of a percentage change, because the percentage change may be easier for us to look at and consider which accounts we want to dig in on. We can consider this basically a kind of a vertical analysis type of procedure and a horizontal analysis type of procedure, an analytical procedure. We have trend and ratio analysis, so we can look at the trends and we can look at the basically ratio analysis with the comparison of account balances as well. Test of selected account balances. So now we have the tests of the selected account balances. The auditor may need to examine important revenue and expense accounts in more detail. So we may pick some of those revenue and expense accounts. We may pick some of those revenue and expense accounts to look into in more detail based on basically our analysis, our ratio analysis, or our analytical procedures. And we might be just considering that some accounts on the income statement are going to be more important and we want to basically select them and do more testing on them just in general. Generally, the auditor verifies the transactions in the account by examining the supporting documentation. So we're going to basically pick the accounts that we want to examine in more depth. We'll probably get the detail of it, the general ledger, the activity with regards to it, and then test the supporting documentation for that account. Accounts audited like this are often related to income tax reporting and can include legal and audit expense, travel and entertainment, charitable contributions, and other income and expense type of accounts.